A lot of ideas, a lot of technology, scaling, all those ideas came out in 2018 and 2019. The first thing that really got adopted was in 2020, and that was called the decentralized exchange.
Welcome back to Investment Tribe, where you subscribe because you want to learn all about cryptocurrencies, NFTs, and other digital assets. Don't forget to leave us a thumbs up and enable the notifications so you'll be alerted whenever we post a new video. And if you have any questions or recommendations, please share them in the comment section below. Today, I will talk about decentralized finance or DeFi, how it works, how it differs from centralized finance, and what are the 5 pillars that make up DeFi. So just sit back and relax. I'm not gonna bore you with any more intros. So let's start with it right away. I guess to understand what decentralized finance is, we need to understand what is centralized finance first. The standard for the world today is there's always an authority who controls the flow of money, and that's the government and the banks. They can print more money if they want to, they can stop someone from borrowing money or from making a bank account, they can even block investments if they wanted to. And lastly, loans can be ridiculously high too. Payday loans sometimes reach up to 500%. Credit cards to 25%, and personal loans at 18% on average. So in centralized finance, people heavily rely on these 2 institutions because there's no alternative. But not anymore. Decentralized finance or DeFi will change the global economic platform. DeFi has no banks, and its rules are defined by the code that it was written in. DeFi is practically a computer program that can act as a bank, and it's open source so anyone can review the code and analyze its terms. But the most important aspect is that it's way cheaper than centralized finance. So now, we will talk about the 5 pillars that make up DeFi. First, let's talk about stablecoins. These are the bridges that connect DeFi with centralized finance, because these are the coins that are matched with real-world assets like certain currency or gold. Examples of this are DAI, Tether, and USD coin, which are crypto coins that are priced the same as US dollars. So, one coin is worth $1. What is the purpose of this, you might ask? Well, again, let me show you how traditional trading is done. Say you have bought one Ethereum coin for $500, and now its price jumped to $1,000, so you want to sell your Ethereum to make a profit. What people normally do is that they go to a centralized exchange like Coinbase or BINANCE to convert that Ethereum coin back into US dollars. Of course, they will take a transaction fee for processing this, and they will even inform the IRS that you gained money, so you will have to pay tax for it as well. Then, the Ethereum price drops to $250, so you withdraw your $1,000 to the bank to buy 4 Ethereums. Again, this whole process takes time and fees to be completed. The process takes very long considering that in the crypto world, the price of coins can change every hour or even minutes. Now let's compare this whole process, but we will just use USD coin. Again, you bought one Ethereum coin for $500 and the current price is now $1,000. Instead of going to Binance or Coinbase, you decided to just convert your one Ethereum coin to 1,000 USDCs. Then, Ethereum drops to $250. In just a very short time, you were able to convert your one Ethereum coin into 4 Ethereum coins. So if Ethereum's price rises again, say $500, you will now have $2,000 of earning. You do all of these transactions without taking many fees, and it's very easy too. Another advantage of stablecoins is that you can easily move huge amounts of money without needing to be approved by a bank. In the US, transactions over $10,000 are required to be approved by a bank first before going through. But with USDC, you can move around $10 million with no hassle at all. The second pillar that I want to talk about is lending and borrowing. We all know money gets around through lending and borrowing. Banks get profit because of interest from loans, and they are protected by law so that you will always pay back your loan. But you can imagine that in the crypto world, everyone is anonymous, so you can just borrow and then never pay back again because you know that they will not come after you, right? Well, that's one of the biggest challenges that developers had to face when dealing with loans on this platform. Let's look at these 2 scenarios. Person A wants to earn profit by lending his coins, and Person B wants to borrow coins. For Person A, it's simple. He can just deposit his coins into crypto lending platforms like AAVE, and it will be converted into another token that has a value of his original deposit, plus interest. Again, this transaction is fast and requires no humans to do the calculations. Now you might be asking, where do AAVE get the interest? Is it sustainable for all lenders? The answer is yes. The interest will come from borrowers, or in our scenario, person B. If he wants to borrow coins, say for example, worth $100, he must put $120 first. That way, when he decides to not pay back the loan, his collateral of $20 will go to person A or to other lenders. So if you want to convert your Ethereum coins but you don't want to sell them completely because you believe that they will rise in the next few weeks, then you can just convert them to other coins through lending. Say you got 10 Ethereum worth $1,000 and you borrowed 800 Tether coins by putting those 10 Ethereum into collateral. Now you can trade your Tether coins however you want. If you made a profit out of that and you saw that Ethereum's price rose, then you can pay back the collateral 10 coins and sell those two. So now you made a profit from these 2 coins. But of course, luck is random. If you have a net loss in trading the Tether coins, then either you pay back the collateral by the original amount, which will cost you to pay the extra money, or lose forever those 10 coins. There is, however, another type of loan in crypto that you absolutely cannot do in the traditional way. This is called a flash loan. It is called that because it normally lasts around 10 seconds. This loan does not even involve you putting in money. So this exploits the different values of coins in different platforms. For example, Ethereum is worth $10 in Coinbase and $11 in Gemini. So what you can do is borrow 10 million coins using this flash loan and then instruct to immediately sell them to Gemini. So your 10 million will easily become 11 million. Now since you loaned the 10 million, they will immediately take it back with a very little fee. And you are still left with 1 million. So with this exploit, you can earn a huge profit in just a short period of time. The third pillar is decentralized exchanges. Like I said earlier, crypto coins and tokens can be easily traded to other coins and tokens with a very little fee involved. The real-life counterpart for this is foreign currency exchanges. For example, you visited London for a vacation, so you need to convert your dollars to pounds. Foreign exchange traders take advantage of the fact that tourists don't know how much the currency and they immediately need the money, so they change very high fees to customers. Unlike with decentralized exchanges, the conversion rates are written in the code and you can study it so that you would know if you're being scammed. Decentralized exchanges, or DEXs, are sustained by a pool of money deposited by investors. This money gets traded by traders and the fees of every trade would be the profit of investors. Again, these are all written in the code and are not regulated by the government whatsoever. Seems like the code is the law when it comes to the crypto world. The code is also written in a way that investors could pull out their investments from the pool, creating a slot for other potential investors. As I said, DEXs are not regulated by the government, so hundreds, even thousands of coins and tokens can be traded. Unlike, say, Coinbase, where you can only trade 32 coins and tokens because they are controlled by the government, so they need to analyze each one before including them in their list. That's why DEXs like Uniswap or PancakeSwap have liquidity pools amounting to billions of dollars. So for the fourth pillar, we have insurance. This one is pretty straightforward and is pretty much the same as current real-life insurance systems. For those of you who don't know, insurance works by studying statistics and the probability that an accident will happen to use as a basis and the rate. For example, you went and insured your new car. The rate is $100 per month. When an accident happens that causes total wreckage to your car, the insurance company will conduct an investigation to check if you are eligible for the full amount payment so you can buy a new one. You might think that $100 a month is too low, but these insurance companies employ statisticians to compute the probability of car accidents. Since not everyone will have an accident, the payment of all who got the insurance will be pooled to cover for that wrecked car. In DeFi, the same principle applies, but the improvement is that the investigation process can be done through computer code or what we call smart contracts. Say, for example, a farmer wants to insure his crops so that he will still get a payment if ever the crops die during the summer. So the smart contract can be written with a requirement that on any given day, if the temperature reaches 95 degrees Fahrenheit or above, the farmer will be automatically paid, no questions asked. In some cases, insurance companies may also employ humans to verify the requirements are met. In our case, they may instruct several humans to check the actual temperature every day. These humans, together with the smart contract, are called oracles. And for our last pillar, we have margin trading. This one, like insurance, is not much different from the real-world application other than it is quicker, accessible to anyone, and safer. So let me explain to you what margin trading is. Say you want to invest in Apple, so you get a loan of $100 from the bank. By using margin, the bank approved that you only pay $20 as a down payment, but the subsequent payments will have an interest of 5% annually. Here, we will have two scenarios. First is if the stock price rises to $150 and you decide to sell it. You will earn $70 because you will only have to pay the remaining $80 loan. So your initial investment of $20 increased by 300% even though the stock price only rose by 50%. Now if the price goes down, the bank will force you to sell your stock once it reaches the remaining balance of your loan. In our case, $80, so that you will not go into total nosedive once it reaches, say, $50. You will still lose profit, but not by a huge amount. I hope you learned about decentralized finance or DeFi. Please also comment on what topics you still do not have a good grasp on, and maybe we will cover them in a later video. Well, that's all for now. This is Investment Tribe. See you again tomorrow. Keep in mind to like, share, and subscribe.